2025년 9월 9일 증시 시황에 대해서 말씀드리겠습니다.
Okay, today was one of those days that was just packed with contradictions. We got some really shocking news that the US job market is way weaker than anyone thought. But how did the stock market react? Well, it basically laughed in the face of all that worry and smashed through to a new all-time high. Now, at first glance, that makes absolutely no sense. So what on earth is really going on behind the scenes?
This right here is the central mystery we're going to solve today. How is it possible that nearly 1 million jobs just vanished from the statistics, yet investors turned around and pushed stocks to record prices? It feels like it goes against all common sense, right? Well, the answer starts with one very big number.
First, I just want you to take a second and let that number sink in. The U.S. government revised its job numbers for the past year, and it turns out they were off by 911,000 jobs to the downside. It's like the entire workforce of a major city was just erased from the data. A number this massive would normally send shockwaves of fear through the market. But this time, it didn't. Why not?
And here is the very first clue to our mystery. That shocking number wasn't actually a shock at all. You see, Wall Street experts were already expecting a drop somewhere between 800,000 and 1 million jobs. So when the actual number came in right smack in the middle of that range, the market's reaction was basically a collective shrug, as if to say, yeah, we knew that was coming.
So this is the most important takeaway. Because the bad news wasn't a surprise, the market didn't treat it like a new crisis. It wasn't a signal of an impending recession. Instead, it was seen more like a confirmation of what the market had already priced in, that the economy is cooling down. And that means investors' favorite story, the expectation of a Fed interest rate cut, is still very much alive and well.
And this is where we run right into a fiery debate happening among the top economic experts right now. Everyone agrees that job numbers are bad, but they are completely split on what the Federal Reserve should do next. Should they cut rates to help the weakening labor market? Or could a premature cut actually light a much bigger fire?
On one side, you have optimists like Rick Rieder from BlackRock. He argues that the fundamental health of the economy is still strong. From his point of view, a rate cut isn't an emergency procedure for a crisis. It's more like a fine-tuning, a simple adjustment in an already healthy environment. That neutral rate he mentions, that's just the theoretical interest rate that keeps the economy perfectly balanced, not too hot, not too cold.
But then you have cautious voices, like longtime bull Ed Giardini. He's waving a red flag, warning that cutting rates right now could be incredibly dangerous. What he's afraid of is that a premature rate cut could trigger something called a melt-up, which could be followed by a violent crash.
So what exactly is a melt-up? The easiest way to think about it is like a market sugar rush. It's when asset prices explode upwards, not because the economy's great, but because of FOMO, the fear of missing out. Investors rush in blindly, pushing prices to irrational heights. And as we know, bubbles like that, they usually end with a painful pop.
And finally, you have the deeply pessimistic camp. Mark Zandi from Moody's is a key voice here. He sees that 911,000 number as a clear and present danger. For him, this isn't just a sign the economy is cooling off. Nope, this is a direct warning that a major recession could be right around the corner.
Now, this pressure on the U.S. Fed to lower rates isn't just an American story. To really understand what's happening, we have to zoom out and look at the whole world. Because right now, there's a powerful global trend that's making it very difficult for any central bank to tighten the money supply.
Just look at what's happening. Policies that involve cutting government spending and raising interest rates, what we call austerity, have become political poison. In France, Argentina, and Japan, leaders who pushed for austerity have recently lost support or have been forced out of power. This global political reality is putting pressure on all central banks, including the one in the US, to keep the money flowing.
Okay, so let's try to wrap up all the chaotic action we saw in the market today. To really get it, you have to weigh two different stories against each other. On one side, you have the optimism, the reasons for the bull market. And on the other, you have the pessimism, the shadows lurking beneath the surface.
So looking at the bright side first. The market absorbed the job shock because it was within expectations. The hope for a rate cut is still very much alive. And, most importantly, this bull market isn't just built on hope, it's backed by solid corporate earnings. On top of all that, there's this massive optimism about the productivity revolution that AI is expected to bring.
But the shadows are definitely there. You simply can't ignore the reality that 911,000 jobs disappeared. That's a real hit to the economy. This has led to growing distrust in the data and a real fear of recession. There's also that melt-up risk we talked about, the danger that a rate cut could create a dangerous market bubble. And there's a growing concern that maybe, just maybe, the market's optimism is ignoring weakening fundamentals just below the surface.
And so in the end, we're left with this one final question. Is the market today a brilliant forecasting machine that's correctly seeing a soft landing and an AI-driven future, or is it in a state of denial, willfully ignoring the obvious warning signs in the economy? The answer to that question is going to determine where the market and all of our money heads next.